Hello and welcome to the program. I'm Stephanie Stanton with ETF Guide. It is great to see you again. If you are new to ETF Guide TV, hit the subscribe button and post your questions or comments below. We would love to hear from you. Well, more investors and financial professionals are becoming keenly aware of the need to combat higher interest rates and higher inflation. Well, here to help us make sense of it is Paul Baiocchi, Chief ETF Strategist at SS&C ALPS Advisors. Paul, thank you so much for being with us. It's good to see you.
Yeah, likewise. Thanks for having me. I'm excited.
Yeah, absolutely. You know, we've seen a swift jump in the prices of everything from crude oil to industrial metals. Give us the big picture view. What is behind the inflationary pressures that are pushing prices higher, and how can investors position their portfolios accordingly?
Well, I think in many ways, it's a perfect storm that is driving prices higher. You mentioned base metals, you mentioned energy, and the dynamics there are fairly straightforward. We've had an underinvestment in new production and energy in the United States, and globally we saw other big suppliers either cut back on production coming out of the COVID crisis or not ramping up production. So here in the United States, whereby the regulatory environment was a little more restrictive and production started to decline as a result of the COVID crisis, all of a sudden when demand snaps back, you get an imbalance between global supply and demand. And that's true for both crude oil and natural gas. And so naturally you have this upward pressure on the price of crude oil as a result of that supply and demand imbalance globally. And then you start to see it work its way through the economy in terms of the price of various goods, the types of the prices of refined products like gasoline, et cetera. But also because crude oil and petroleum products are an important input into so many household goods, it starts to find its way into the economy. And base metals is similar in the sense that you already had a very tight market for various base metals, aluminum, copper. You had emerging sources of demand for those metals, specifically electric vehicles, which use a lot of things like copper. And so when you have that type of tight supply market already, and then you have supply dislocations coming from a geopolitical event like the Russian invasion of the Ukraine in a market that is a fairly big supplier of things like base metals or even agricultural commodities, it's going to put upward pressure on the prices of those various commodities, base metals, as well as agricultural commodities. So in that sort of primary market sense, the drivers are pretty clear. But then you think about all of the finished goods, all of the everyday products that people consume, which have been impacted by global supply chain woes, and you add it all up, and all of a sudden you can see the price rising in everything. And that's not even considering labor market pressures and wage increases.
Yeah, there's a lot going on. Let's shift gears a little bit, talking about the Fed and interest rates. Obviously, to combat inflation, the Fed is expected to aggressively raise rates, and bonds with the longest maturities are already falling in value faster compared to bonds with shorter durations. How can investors minimize duration risk?
When you're talking about fixed income, I think certainly you want to go shorter on the curve in general if you're trying to minimize the duration of the fixed income segment of your portfolio. And you think about the the Barclays Aggregate Bond Index, which is the benchmark widely used for fixed income allocations and often owned in large chunks by investors through index ETFs and the like. That's an index whose duration has slowly crept up over time. And so I think when you enter 2022 from a neutral perspective, 60-40 or whatever the case may be, and the ag is sort of the linchpin of your fixed income exposure, you necessarily have a significant amount of duration risk. And so investors can either lean on an active manager in their total bond strategy to give them perhaps more managed exposure to that type of interest rate risk. They can also, as I mentioned before, perhaps invest in shorter term credit, both government or private. And that's one way that you can, at the very least, offset some of the interest rate risk you might have in other pockets of your fixed income portfolio. But I think ultimately, when you think about your asset allocation in aggregate, what you have to really do is just compartmentalize the pockets of your portfolio that are trying to achieve different things, your income sleeve versus your total return sleeve. And then underneath the hood of that, figure out what types of factor exposure you have and how sensitive the industries, the sectors that you have exposure are to interest rates, changes in the interest rate environment, and then try and reconstitute the portfolio to adjust for your new expectations for the level of and the trajectory of interest rate increases.
So the equity market, like bonds, also has some duration risk. As we've seen, investors rotate away from growth stocks into value stocks. Tell us a little bit more about equity duration risk and how to manage that.
I think the foundational concept that most people use for valuing companies that you learn in B school or even in introductory financial courses or in the CFA curriculum is discounted cash flows. And if you think about it simply, what you're doing is taking some estimated amount of future cash flows and bringing it back to the current market using a discount rate. And so if that discount rate goes up, the value of those future cash flows necessarily declines. And therefore, in theory, the valuation of that company declines. So if you have companies whose cash flows aren't as far out into the future, aren't as uncertain, and therefore their valuations aren't as impacted by rising interest rates, then in theory, those companies at the very least should have stable relative performance compared to companies who don't have earnings now, have expected cash flows 5, 10, 15 years from now, and have been repriced downward in the market context. And so when you get to value versus growth, you think about growth companies, and certainly there are exceptions, but many growth companies have a lot of their cash flows at some point in the future, not necessarily as much of their cash flow profile here, whereas value companies typically have cash flows that are near dated. And when you look at a value portfolio versus, say, a growth portfolio, just at an index level, what you end up having in a value portfolio is more exposure to energy, more exposure to financials, more exposure perhaps even to materials, whereas in a growth portfolio, you don't have any exposure in some cases to those sectors. And those sectors, from a PE ratio perspective, from a price to book perspective, or from other valuation measures, tend to screen as cheaper. And if you think about the nature of energy companies right now, they're certainly generating free cash flow in a meaningful way. We saw Exxon and Chevron both report pretty robust free cash flow generation now. And so just mechanically, you think about the nature of a company who is generating free cash flow in the here and now versus a company that's expected to at some date in the future. Certainly, interest rates are going to have very different impact on the valuation of those two companies or those two examples.
And you talked about energy. Quickly before we go, energy, of course, a top performing S&P 500 sector this year. You mentioned it a little bit. How can investors balance the desire to be plugged into the current trend while preparing for a future state of the energy market?
Yeah, I think energy has been a bad word for some investors, either because they use an ESG framework or just by virtue of the performance. I mean, over the course of the past 10 years, coming into 2022, energy was the worst performing sector 6 out of those 10 years. And it was the highest volatility sector over that period. And yet last year it was the best performing sector, and it is the best performing sector so far in 2022. So the reality is that it's a small slug of the S&P 500, just around 4% of the market by weight. And so if you're underweight energy, that means you're likely lagging the market just from a neutral perspective. If you're overweight energy, you might be outperforming. But I don't know that investors appreciate just how important some of these legacy energy companies are going to be to an energy transition. And so if you want to have exposure to battery companies or electric vehicle companies or fuel cell or hydrogen or any of the themes within the renewable energy space, that's fine. And that is an option, if you will, on some of the longer term trends in the energy renaissance or in the renewable energy transition. But you still need a ton of natural gas. You still need a ton of crude oil in the meantime, and pipelines like MLPs that are in a portfolio like AMLP or ENFR give you that exposure, but also will have a role to play in the transition and can be paired with something that's renewable energy focused, like the SS&C ALPS Clean Energy ETF ACEs. And that's what we talk about. Is it's not just about energy now or energy 25 years from now. It's about energy now, energy in between now and then, and energy in some future state, which, to be frank, we don't really know the complexion of, but we know the various technologies that are being developed to hopefully provide alternatives to the energy sources that we've relied on for so long.
All right, we're going to have to leave it there. Paul, thank you so much for stopping by. It's great to see you.
Great to see you as well. Thanks for having me.
And for more information, visit alpsfunds.com. The link is posted in the description section below. And don't forget to subscribe to ETF Guide TV. Tell us how you've been enjoying our timely programs like this one, along with ETF Battles and the many others. You can also find us on Twitter at ETF Guide. I'm Stephanie Stanton. Thanks so much for watching.